Welcome back to Tax Threat, our special segment where we are speaking with tax experts on what are the various points that are spooking the stock markets after the Prime Minister said on Saturday that those who benefit from stock markets should contribute more by way of taxes. Now, we identified three areas. One, of course, is basically more taxes, taxing dividend at the hands of those who receive it, or perhaps dividend stripping and such other forms, or using losses generated in the stock markets to save on taxes. We also discussed the possibility of GAR, or general anti-avoidance rules, that come into effect on April 1st, as well as the indirect transfer rules that clarifications that came last week. Three sets of confusions that are clouding the markets thinking or worrying the markets. Well, Tejas, in that set of indirect transfer and the attendant taxes that might apply to those who benefit or those who are owners of the asset that is transferred, the carve-out said that very clearly small investors holding no right of management or control of such company entity holding less than 5% of the total voting power, share capital, interest of the company or entity that directly or indirectly owns the assets situated in India. Now, what happens to those who own units of a mutual fund? If they own up to 5% or more, they don't have actually voting power. They're only owners of units. Would they be spared?
No, I don't think they would be spared. I think the law is very clear, whether it is a company which issues shares or whether there is a mutual fund which issues units. If you are an investor holding more than 5% stake, then the provisions will apply to you. And like I said earlier, if you have a two-tier structure and, to have a feeder fund and a master fund is a very common fund structure. In that case, in all cases, the feeder fund would hold 100% in the master fund and, you won't be able to avail of the exemption. So ultimately, the investor is going to lose out in the process because of the imposition of this tax.
Okay, so Tejas, quick follow-up, 30 seconds before we get back to GAR. In that case, how disruptive is it going to be? I know it's a tough guesstimate here, but what proportion of the India dedicated funds right now, the manner in which they're structured, what sort of market disruption are we talking about?
No, I think it is going to be fairly disruptive. It is not comparable to, the scenario that you have in international markets. So it's, I think, going to make India a little uncompetitive. So I think that's a big factor that one needs to take into account. And it puts an onerous withholding obligation on the FPI to trace its investors, to withhold the tax, and then to file withholding tax returns. I think all of this is going to be extremely cumbersome and make India look fairly uncompetitive.
So, Mr. Kanabar, Mr. Kanabar, is India an outlier in that case? And therefore, will we be singled out for punishment by FIIs?
So two parts to it. First, Lata, if we tax capital gains, will we be outliers? The answer may be no. There are several jurisdictions which tax capital gains. There are several others which do not. But this taxation at a parent level is something which is unheard of, primarily because it is, as Tejas was mentioning, not only difficult, but almost impossible to comply. So we have gentleman, Mr. X, who is a resident of UK, selling of shares to another person of Germany into a fund which is India dedicated, and you are looking at withholding. How does one really comply with such a provision? So it's tried to say that impossibility of compliance should not be sort of a matter of law. Law is what it is. But really, you do not make a law and reiterate a law which is almost incapable of compliance. And to that extent, India certainly would be an outlier.
Mr. Kanabar, sir, coming back to GAR, the point you made before the break was extremely important. In case there would be the interpretation that GAR is actually going to override specific limitation of benefits in treaties like the Mauritius Treaty, then what are we really talking about? Because I believe these LOBs, they have specific tests, tests to prove substance, which includes the expenditure that you have, the purpose itself, etc. Is there a possibility that GAR will override? And then what happens? Because, as of now, the market was fairly comfortable. There was a 2-year window. The Mauritius Treaty sunset clause was, I think 2019. So then how bad could this be?
So two parts to it. First of all, it is not an interpretation that GAR overrides tax treaties. That is what the GAR provisions specifically say. So it's not a question of a grey. It's very categorical that GAR provisions override provisions of the tax treaty. That said, in the context of India-Mauritius Treaty, for example, there's a specific provision grandfathering from levy of capital gains tax all investments that have been made prior to 31st March 17. So those get grandfathered in a sense that the treaty as it applied prior to 31st March 17 will continue to apply even when you unwind the whole thing. To that extent, one could be fairly comfortable. But investments made after 1st April 17, which is what we are looking at in a forward-looking scenario, there is no treaty availability at all, because the provisions of GAR would definitely apply, and therefore the question is, are you entitled to treaty at all? That's
and if they renegotiate the treaty, then why was the sunset clause introduced in the first place if GAR was going to come in?
No, that was for the previous. It was only for grandfathering.
The grandfathering, but the subsequent. In effect, are we saying that the Mauritius Treaty for investments after April 1, 2017 is null and void if GAR comes in?
Absolutely. No, I think that's the point he's making. It is only for investments made before that, right, Mr. Kanabar?
Correct. So we have a 2-year thereafter a transition provision where the taxation is at the rate of 50%, which applies only to matters going in and out, meaning purchases and sales made within that 2-year window. Now let me just bring in another issue, and I don't again want to be too very technical, but there is something which is quite historic which happened a few weeks back, which is a multilateral instrument where all about 100 countries are signing a common tax treaty. And one of the things, both Mauritius as well as India are likely to be signatories to what we call as MLI, a multilateral instrument. Once that multilateral instrument gets signed, then a question which arises is whether even the grandfathering is valid or not valid. And I do hope that the powers that be in the North Bloc really come out to clarify that whether the grandfathering will be, that it will be valid. Okay. Because if it is not, then we are looking at literally chaos.
Okay, well, Mr. Raina, we are out of time. But sir, if an FI were to come and ask you for advice, what are you going to tell them to actually sell out a goodish bit where they think they are liable to be taxed up until the budget? What will be your advice to them?
No, I think FIIs obviously will go by the treaty provisions. You see, you must understand one thing, that one country cannot unilaterally say that their law will prevail over a contract, an agreement which has been entered into with a foreign country, because that is governed by international law, and one country cannot renege on that. Therefore, this GAR provision does mention that the GAR will overrule the treaty, but I don't think the other countries are going to accept it, taking it lying down. Okay. They are going to fight for it and say, look, you cannot unilaterally change something which we have entered into as two sovereign nations. We are governed by international law. And therefore, your provision in GAR will be struck down as being invalid. You will not respect that provision and will not accept it.
All right, so this really enters into a territory of two sovereigns arguing, and if, as Mr. Kanabar says, all these sovereigns are signatories to yet another treaty where even the grandfathering would be questioned, I think there is enough material out there for FIIs to be spooked. We will continue with this discussion in future episodes as well. Thank you very much, Mr. Raina, Mr. Kanabar and Tejas for joining us on this special tax threat show.